we'll be looking at today, which is the pay TV industry and the communication services sector. Hopefully you had a chance to look at the article from last week, which was a preamble to this webinar. But if you didn't, that's fine as well. We'll still talk about it throughout the course of the webinar and at the end when we tie everything together. And then, so after that, we'll run the efficiency and management screener. And then under that one, we'll try to find out which stock between Comcast and Dish has a better business, has a more efficient business, and which one has better management. And then we'll proceed to the valuation and growth screener. And under that screener, we'll delve into detail about trying to find which company is cheaper and has significant growth potential. And then in the summary, we'll try to tie our findings from the article as well as from our screeners together. After that, we have Q&A, and joining us will be Howard Reisman, who's our CEO here at Rover, to answer questions. That said, just a disclaimer, this webinar doesn't constitute investment advice to buy or sell a particular stock. We recommend that you do your own due diligence if you're choosing to buy or sell a stock. And then this webinar is being recorded, so we will have the recording up on our website in a few days after that. I think that's it, so let us get to the webinar started. To start off, we'll start off with the industry first. So both Comcast and Dish are in the pay TV industry and the communication services sector. And generally, if we want to gauge the performance of the industry or the sector in Rover, you can come over to the navigation tab on your left, click on markets, and then go down to sectors, and under sectors you can come down to communication services, and under that will be the pay TV industry. And so to see the performance of the pay TV industry over time, you can just right click on that and click chart, and that will bring up the performance of the pay TV industry over the 10-year time period, because that's what our timeline is set to. And then you can compare that to the sector. And so if we go up to communication services sector and right click on that and scroll down to compare, if you go down to compare, you can see that if you click on comparing chart, that will bring up the performance of the sector as well over time. And then if you come to benchmarks and the chart itself, you can click on that and scroll down the S&P 500 and click on the S&P 500, and that will bring up the performance of the S&P 500 over time. And to get a clearer picture of the performance of both the communication services industry and the pay TV industry, you can baseline the S&P 500 by just clicking it, and that will flatten it out. You can see the performance of the pay TV industry over time. It's been doing fairly well. And then if you reduce, if you take that the timeline to 5 years, you can see that the pay TV industry is still performing relatively well compared to the sector as well as the S&P 500. So generally, when picking an industry, it is preferable to pick one that choose a stock that is in an industry that is outperforming. And so, but of course, there are exceptions to that rule. And the first one would be that you're choosing a stock in an industry that is about to experience a turnaround, or and you think that the stock you're choosing is better positioned than its peers to take advantage of the changing trends within the industry. The other reason you would choose a stock in an industry that is underperforming might be because you think you know the stock has economic moat, and economic moat basically means that it has competitive advantages over its peers that can't easily be eroded. And so how that looks like in stock Rover is we can come over to the tabs and the industry versus sector versus view. So this is a tab I created that compares returns from the industry, the sector, as well as the S&P 500, and it goes back 10 years. And so if we look at our two stocks, you can see that over 10 years, Dish has been performing consistently well against the S&P 500, against the sector itself, and against the industry as well. And so there's very little red on Comcast returns, except maybe for the 3-month return against the sector. And so for why this might be a sign of economic moat might be that for a company to consistently produce these returns over time, it means it has some edge that its competitors can't easily erode. And so that is not the case with Dish. As we can see, it's been underperforming its sector, its industry, as well as the S&P 500 for about 2 years now. And if we go back up to 10 years, we can see it's also underperforming the industry in the 10-year return. And so that, I guess those are two exceptions. And so just off the bat, you can see that Comcast has a certain advantage over Dish that Dish hasn't been able to replicate the level of returns that Comcast has. And then if we, after looking at the industry, we can go right straight to our screeners, and then we'll first of all start off with the efficiency and management screener. And so if we come down to the navigation tab and just run the screener, that will bring up the rankings. And I'm using a ranked screener, so that just means that the individual metrics are weighted. So if you go back to the outline, you see that I weighted the metrics equally between efficiency metrics, so 50%, and management metrics, 50%. And the individual metrics themselves shown on your screen, you can see I have the buyback yield in there, it's weighted to 10%, EBITDA margin 5%. And so both of them, both efficiency as well as management metrics are both equally weighted in the screener. But the results we are seeing on the table are not, I didn't specify the industry, so they're showing results from the entire database of stock over stocks. And so if we go down to the screener itself and right-click on that, we can scroll down to apply rank screener to the watch list, and that will just apply to our two stocks that we're comparing. And so if we bring up, that gives us the rankings, and we can see that overall on management as well as efficiency metrics, Comcast is ranks first and Dish comes in second. This would have been red, so the red just basically means that Comcast or Dish are not passing a certain criteria. So if you hover on the 1, that will bring up the list of the criteria that was in there. And so we can see that Comcast isn't passing our filter for the quick ratio, and I had specified that to be 1, but Comcast has a quick ratio of 0.6. Generally, stock investments are those that have a quick ratio above 1, but Comcast isn't passing that metric. If we come down to Dish as well, you can see that it's also not passing the quick ratio. It has the same. It's also not passing the filter of a quick ratio of 1, but they both are not passing the same criteria. So the ranking still stands. Overall, Comcast is a better stock on efficiency as well as management. And so from there, we are going to go into the individual metrics themselves. So we'll start off with the efficiency metrics, and those are under the profitability tab in stock Rover. And so if we go up to profitability tab, you can see the efficiency metrics. And then after that, we'll go on to the management metrics. So let's get started with the efficiency metrics. So you can see that I subdivided them into 2 groups. So the ones that are color-coded in yellow are operational metrics. And then the ones that are in purple the capital efficiency metrics. So with capital efficiency metrics, they're trying to gauge how well a company employs capital. And under the efficiency metrics, they're basically trying to gauge how efficient a business is being run. And so with efficiency metrics, like for instance the gross margin, you're trying to look at how well can a company keep its cost of goods sold low, and is that improving over time? Or how good is its pricing strategy, and or how much product and services is it producing? And so overall, just from the efficiency metrics, you can see that overall Comcast has better operation efficiency metrics than Dish. And so on the gross margin, you can see that it has almost a 70% gross margin compared to Dish's 25%. And then if you come to the EBITDA margin, you can see that it has a 33% gross margin. Dish has only about 17%. The same story with the operating margin. So with the operating margin, you're subtracting selling and general expenses and other operating costs. And on that metric as well, you can see that Comcast is doing fairly well compared to Dish. And that translates to the bottom line. So it has a better net margin than Dish as well. If we go to the capital efficiency metrics, you can see that on return to equity, Dish has a better return to equity than Comcast. And then if we go to the return on assets, you can see that Comcast has a better return on assets than Dish. It also has a better return on invested capital than Dish. And so you can see that on 2 out of the 3, Comcast is is more efficient at employing capital than Dish. With return on equity, that's basically the net income divided by the shareholder equities. So, and it basically tries to measure how much return a company can produce without taking into consideration the capital structure. So it doesn't account for debt. And so companies that have a higher debt level also tend to score really high on that one. So the number that for Dish seems a little suspect for me, just because Comcast has been fairly well on the other 2 metrics. And so to kind of get a clearer picture of what's happening to the metrics over time, we can go over to the tickers themselves, right on the left side of your screen, and right next to the ticker there's a triangle right there, and you can click that, and that will bring up the historical data for the 2 stocks. And so we can try to see over time whether each company has been either improving its efficiency over time or has it been declining. And so if we get to the gross margin for Comcast, you can see that since 2006, the gross margin was 63.9, and that's trended up, and it's around now it's at 69.7%. So it's been improving over time. So that could speak to either the cost of goods sold is going low, or that Comcast is able to command higher prices for its goods and services. And then if we go to Dish, we can see that since 2006, over time, the gross margin has declined. So it was 36.7 in 2006. It's now come down to 24.5. And so that is a sign that either the cost of goods is going up, or that Comcast is not able to command higher prices compared to Comcast. And then if we go to the EBITDA margin, you can see that Dish, the margin has also, the EBITDA margin has also been declining over time. And then for Comcast, the EBITDA margin has also been declining over time. So maybe this is an industry trend, maybe just the cost, the non-cost of goods sold expenses are rising for both of them. And then if we come to the operating margin, you can see that over time for Comcast, it was 18.1% in 2006. That's risen up to 21.5 over time to today. For Dish, the operating margin, also called the EBITDA margin, was 4.2% in 2006. It's come down to about 8.8%, and that is not a good sign. And so we can see that on this metric, Comcast is also winning. And if we come to the net margin, the bottom line, for Comcast, that was 9.4 in 2006. It's risen up to 11% in 2016. For Dish, it was 6.2 in 2006. It's come down to about 5% now. So again, this trend for Comcast is not very good. So over time, Comcast, I mean, for Dish isn't very good. So it seems that over time, Dish isn't becoming more efficient. Actually, the opposite is happening. But for Comcast, you can see that over time, its bottom line is getting better, its operating margin is getting better, so, and the gross margin is getting better. So on operating margins, you can see that definitely Comcast wins. And then if we switch over to the capital efficiency metrics, so this is sort of looking at historical data is one way of comparing them, but another way of doing this, we're going to use this one for the capital efficiency metrics, is you could use the chart to compare return on to compare the trends over time. And so if we close up the data, we'll open it up later, and go down to the chart and plot the return of Dish and Comcast in our chart. We'll start off with Dish, Comcast first. And then let's close this up, and then go to fundamentals. And then under fundamentals, you can go to the metric packages, and those you can customize them however you want. And so I separated operational efficiency metrics from capital efficiency metrics. So if we bring those up, the capital efficiency metrics, you can see how Comcast has been doing over time. And so you can see that over time, the return on equity, which is the first chart you're seeing, has been rising over time, and this is over 5 years. So over 5 years, you can see that the return on equity for Comcast has been going up. And that is also true for the return on invested capital, the return on assets as well. And so overall, you can see that Comcast over time is becoming a better employer of capital then we can compare that to how Dish is doing. And so we just bring up the chart for Dish, and then this will show us the metrics for Dish over time. And then if we look at return on invested capital, which is in orange, you can see that over time this has also been declining for Dish. So this could be a sign that Dish is having a very hard time competing in the market. And this is also true for return on assets. So return on assets is basically net income divided by total assets. That accounts for total assets, both liabilities, total liabilities plus shareholder equities. So if you account for the capital structure, you can see that actually Dish isn't getting better at employing capital over time. So that's not a good sign for Dish. And then if you look at the return on equity, this has been rising for Comcast. So if we look at from its time in 2011, this has gone up to 27%. So, and I'd say that the number for return on equity is a little suspect, just because return on equity could easily be manipulated. And one way the companies do that is through write-offs. So a company will write down assets, or maybe assets are impaired, and that happened with Dish recently. They recently impaired the D1 satellite, and that brings down the total assets, and total assets going down means that the net, the shareholder equity rises. I mean, it goes down as well. So that will push return on equity up. And if we go back to the table, you can see that I plotted, I added columns that make up the individual metrics on the far right. And so return on equity is made up of net income divided by the shareholder equity. If we go back to the historical data, you can see that over time, Comcast has been improving its net income, as well as the equity has been going up. But the number we're looking at was for Dish. So over time, I think this has also been going down. But why is it so high? You can see that net income has actually been going down over time. But shareholder equity is also slightly rising. And if you look at the shareholder equity is basically total assets minus total liabilities. So the level of shareholder equity has been rising over time, but it's also that it is particularly high because the shareholder equity compared to Comcast is very high. I mean, compared to Comcast is very low. And so that's one reason why the return on equity is fairly high. And then in summary, you can see that overall on both capital efficiency metrics as well as operational metrics, I think under this category, Comcast wins. And you can see that it is running a more efficient business over time, from the gross margin, the operating margin, and the net margin. And it's also becoming a better employer of capital with its return on equity, return on assets, and return on invested capital. And then after looking at the profitability, the efficiency metrics, we can go to management. And under management, there's a tab I created, and this is an assortment of metrics that try to gauge the quality of management that the two companies have, and how well aligned are the interests of management to those of shareholders. This isn't comprehensive. There are other things you can look at. For instance, insider transactions, we'll look at that towards the end. But this isn't shown on the table. So to start off, we have buyback yield. And what buyback yield is basically the net value of share purchases as a percentage of current market cap. And a negative value just means that the company is issuing more shares than it is buying back. And so the opposite of that means that the company is buying back more shares than it is issuing. And so if we go to the buyback yield, you can see that Comcast has a positive buyback yield, so that's a good sign. If you go to Dish, it's a negative number, and so that just tells us that management has been issuing way more shares than they are actually buying back. So that's not a good sign for management, for Dish management. If we come to shareholder yield, which is also the net value of share buybacks, add dividends to it, and then that as a percentage, the sum as a percentage of current market cap, and then a positive number is a good sign. A negative one just indicates that the company is actually benefiting from issuing more shares than it is buying back. And so on that metric, you can see that Comcast has a positive number, which is a good sign for Comcast management, while for Dish, the number is negative. And so that shows that the company is benefiting from issuing more shares than it is buying back. And then if we go to day sales outstanding, which is a metric that measures how long it takes for management to collect after a sale has been made. And so how many days does it collect to collect revenue? And the higher the number, then that means that's not a good sign. You want it to be low, because then that means management collects quicker, it takes less time to collect on revenue, and that reduces the chances of the accounts turning into accounts receivables, and then those accounts turning into bad debts. So you can see that on this metric, Dish has a lower number, so it takes Dish management is quicker at collecting revenue after than Comcast management is at collecting revenue after they've made a sale. And so on this metric, Dish has better management. I think management is more efficient in collecting revenue than Comcast management. If we go to the quick ratio, with the quick ratio, I'm just trying to, as regards to management, you're basically trying to see how well management can handle short-term obligations and how prepared they would be to handle a liquidity crisis if that happened. You can see that both of the companies have the same metric, and so to kind of differentiate them, you'd go back to the historical data. And so if we try to see over time what the quick ratio has been and why it's around 0.6. Generally, with a quick ratio, like we said when we're looking at the filters, that a self-investment will be one that has a quick ratio that's above a 1. But both of them are below 1. So at least we're comparing apples to apples in this case. So over time, you can see that since 2006, the quick ratio for Dish has declined, and if you come to the recent past, it's actually declined drastically from 2.9 to 0.6. Over time, you could say that the quick ratio has been around 1, just because there's 1.0 after the decline during the financial crisis, 0.9, 0.9, then it rises, starts rising. But there's this huge decline at the end. For Comcast, you can see that over time, I think the quick ratio has remained almost the same, around 0.5 or 0.6, except maybe around 2012 when it rises to 1.2. but over time, I think it's been around that level, and so there isn't any sharp decline like we're seeing for Dish. So even though they both have the same quick ratio, just based on historical trends, I think Comcast has a better quick ratio because it's been able to be consistent with that metric. Then we can move over to the interest coverage ratio. So in line with being able to handle short-term obligations, the interest coverage ratio just measures how well a company could handle, could pay its interest on its debt. And so a high number is always positive, and in this metric, you can see that Comcast has an interest coverage ratio of 6, and that's higher than Comcast and Dish's 2.1. And so on that metric, you can see that management is doing a good job of being able to cover the interest payments. And then if we come to the payout ratio, with the payout ratio as well, I'm trying to gauge how much management is paying or balancing growth as well as returning value to shareholders. So the payout ratio is basically how much is paid out in dividends over earnings per share. And you can see that Comcast has a payout ratio of around 30%. Dish doesn't pay out any dividends, so that's 0. And so Dish management is focusing more on growth in that they don't return any dividends to shareholders, but Comcast does. And to kind of see also the historical trend for Comcast over time, you can see that it's historically been around 30%. So it's slightly rising, but it's still within manageable levels. It would have been a bad sign if the Comcast and the payout ratio was rising to over 50%. And so with this, let me bring up a good example of this would be Cablevision, and it's in this quotes. I'll just add it to the table. You can see where the payout ratio would be a concern. And so you can see that Cablevision actually has a payout ratio of around 80%. So it means whatever they're earning, only 20% remains actually as retained earnings, and that is a very high payout ratio. And there might not be. It's not, management is not doing a good job of balancing either funding future growth through returned earnings and returning value to shareholders. And so this number is a little too high for me. And if we went to the historical data, you can see that it's actually been rising way too much over time. It was 40% in 2009, now it's around 80%. If you were looking at this would be a positive sign if actually earnings per share was actually growing. But if you look at earnings per share, you can see that it hasn't grown much. And so this is a very worrying sign for Cablevision. But for Comcast, this is not too much of a worry. The payout ratio has been consistent over time, slightly rising, but at the same time, the earnings have been going up over time. And so that's about the payout ratio. And then we can go to receivables. This one is also connected to the day sales outstanding. And we saw on that metric that Comcast actually was not very good at collecting revenue after a sale has been made. And that also translates to the level of receivables. You can see that the level of receivables as a percentage of current assets is actually way higher than what a Dish has. And then other metrics you can look at to measure management would be compensation, stock-based compensation. And with this, you can bring up the chart, for instance, just because compensation is usually tied to the stock performance. And so you could bring up the charts to see how management stock-based compensation is faring over time historically and compare that to how the price, how the stock is doing. And so if we have Dish in our chart, if you compare that to how, for instance, the level of stock-based compensation, you can see that this was rising over time and it has dropped off recently, and I'm guessing that corresponds with this downturn and how the stock has been performing. And so that would be a good sign that for Dish that management isn't still paying itself, even though the stock isn't doing as well. And you can see that over, maybe this is if we reduce the time frame to 2 years and then go to settings and change the price to percentage, you can see that actually the stock has declined 20%, and compensation, if we go back to the table, is also declining. So maybe that's a good sign that management isn't still paying itself high sums, even though the stock isn't doing too well. If we go to Comcast and try to chart Comcast, we can see that actually within the 2 years, the stock has gained at about 13%, and that aligns with how the compensation is also going up. So that's a good sign for, I guess, management for Comcast as well. Overall, just based on buyback yield, shareholder yield, the quick ratio, the interest coverage ratio, the payout ratio, and that earnings per share have been going up over time, I think I'd give management, I think Comcast has better management than Dish, and that was from either Dish management was issuing way more shares and they're buying back. Their quick ratio just suddenly dropped. The interest coverage ratio is lower. They also don't pay out any dividends, so that's a concern for me. And then, so that, I guess, marks the end of the efficiency and management screener, and then we can go to the valuation screener instead. And so let's run the valuation and growth screener, and so that I limited it to 5 stocks, so that will bring up the top 5. If we apply it to the current watch list for Comcast and Dish, then we can get a ranking of Comcast and Dish, and you can see that on valuation and growth as well, that Comcast ranks better than Dish. So this just means that Comcast is cheaper as well as presents a significant growth potential. And with this screener, we're just basically trying to gauge which stock is cheaper, at the same time has room to grow in the future. And so on this one, you can see that overall Comcast is doing better than Dish. This screener is also equally weighted 50-50, just like the efficiency and management screener. And so that means that valuation metrics make up 50%, and growth as well makes up, growth metrics make up 50%. And so we'll do the same thing, just noticing time. And so I guess in the interest of time, I won't be as in-depth with the valuation growth screener as I was with the efficiency and management. And so if we go to the valuation and growth, you can see that Comcast is trading at a fairly low multiple to earnings, 17.8. Comcast and Dish is trading at around 28.4 times earnings. So I think on the PE ratio, Comcast wins. And then if we come to price to sales, Comcast is trading at a fairly high price to sales ratio compared to Dish. And then the price to book, which is the book value, is basically total assets divided by, subtract total liabilities. So that will be shareholder equity as well. And so you can see that on that multiple, Comcast has a relatively low valuation compared to Dish. and so it's cheaper on that metric. And then with one of my favorite, price to free cash flow. Free cash flow is basically the EBIT subtract capital expenditures, so and take out as well changes in working capital, and then add back taxes, and that will give you the free cash flow. With free cash flow, you're just basically trying to measure how much money is coming into the business after the business has spent on maintaining existing infrastructure or on expanding existing infrastructure. And so on that metric, you can see that Comcast is doing fairly well compared to Dish. The number, I guess, I'm guessing if the number is negative, that's why the Dish doesn't have a number there, because if we go to the individual metrics on the far right, you can see that actually Comcast has a positive free cash flow, Dish has a negative one, and the reason why this isn't calculated is that the free cash flow is negative. And so on this metric, Comcast, of course, is way cheaper than Dish. And then on the enterprise to sales, you can see that Comcast is also way more expensive than Dish. And then if you come to the EBITDA, the enterprise value divided by EBITDA margin, you can see that actually Comcast is cheaper than Dish. With the enterprise value, you're basically trying to gauge how much it would cost to buy the business. So it's measured as market cap, adding debt to it, and then taking out cash, because then if you bought the business, you'd be assuming all its debt obligations and then taking whatever cash it had on its books. And so that divided by the EBITDA margin, you can see that Comcast is actually trading at a lower multiple than a Dish. And this actually is probably a carryover from the efficiency we saw with Dish, because then it had a way higher EBITDA margin than Dish. And so this also is also translating into how cheap it is. And I guess we can also look at the PEG ratio, and the PEG ratio just basically tries to measure how is basically the P ratio divided by the forward growth estimate over 5 years for the P for earnings per share. And so on that metric, you can see that usually a lower number indicates a cheaper valuation. So on that metric, Comcast has a cheaper valuation than Dish. And then I'll skip over to growth and just do a wide overview, and then we'll conclude in the interest of time. And so the sustainable growth rate, that's basically trying to gauge how much a firm can grow without needing to borrow. And so you can see that on this metric, Comcast, Dish has a way higher sustainable growth rate than Dish. But the way the sustainable growth rate is calculated is it's basically return on equity multiplied by the return to earnings ratio. So 100 subtract the payout ratio. And if you were actually noticing, you would see that this number is the same, if we go back to profitability, is the same as the return on equity. And so you're basically multiplying by 1. And so even though Dish has a higher number, just because it doesn't pay out any dividends, and the fact that Comcast pays out any dividends, even though it has a higher number, I think on this metric, growth metric, I think Comcast still does way better. The estimated earnings for next year, you can see that Comcast has positive ones, as a positive growth for the next year. Dish has a negative one. And the earnings change, 1 year change, that's for the past, the EPS change for the past year, for 3 years. You can see that consistently Comcast has higher numbers than Dish. So overall, I think on valuation and growth, the round also goes to Comcast. And then from our findings from the article, you can see that in the article we found that Comcast had an edge over Dish that Dish couldn't, or other peers couldn't easily erode. in that it was targeting an urban market and urbanization trends sort of in line with the market Comcast is targeting. It had a cheaper. It was entering the online streaming industry at a cheaper, a more competitive price point than Dish was with Sling TV. At the same time, they just rolled out the X1 platform. Dish, on the other hand, hasn't been very clear about what it intends to, its growth strategy is. So it's been buying up spectrum licenses, and that's been taking up a lot of cash from the company, but it hasn't been very clear about what it wants to do with them. And so whether it wants to enter the mobile, wireless mobile space is unknown at this point. And usually spectrum licenses are very hard to value. So even if it's shelling out all this money, it's not a guarantee that those will pan out. But for Comcast, the core business is still strong. For Dish, that isn't the case. So overall, I think the better pick between the two stocks would be Comcast.